What's happening in the oil market right now is not sudden, and it is not emotional. It's structural. And most people are already behind it. This is not a story about politics, speeches, or short-term headlines. It's about control. Control over supply, infrastructure, and the single commodity that still underpins the global economy. When oil shifts, everything else moves with it. Inflation, trade, capital flows, power. Venezuela is not the headline. It is the pressure point. And the reset that has begun does not reverse quietly. Oil is not a commodity. It is the system. Oil is not simply another input traded on exchanges. It is the base layer of modern economic activity. Every complex economy rests on the assumption that energy is available, movable, and priced within a predictable range. When that assumption holds, systems function smoothly. When it breaks, stress propagates everywhere. Transportation is the most visible link, but it is far from the only one. Food production, industrial manufacturing, chemicals, plastics, and construction all depend on oil-derived inputs. Even digital economies rely on physical supply chains powered by fuel. Oil is embedded so deeply that its influence is often invisible until it shifts. When oil prices move, the transmission is immediate. Freight costs adjust, shipping rates follow. Manufacturers recalibrate margins. Retail prices respond with a lag, but the direction is set almost instantly. Inflation data does not create these pressures. It records them after the fact. Oil acts first. Statistics follow. Economic growth responds the same way. High and volatile energy costs compress demand and distort investment decisions. Stable or declining energy costs expand operational flexibility. This is not theoretical. It is observable across decades of data. Growth accelerations and slowdowns repeatedly trace back to energy conditions. Every major power transition in modern history has been anchored in energy control. Coal underwrote industrial empires. Oil underpinned 20th century dominance. Access, logistics, and pricing power mattered more than ideology. States that secured energy flows shaped outcomes. Those that lost them adjusted downward. Because of this, any disruption to oil supply is never local. It cannot be contained within one country or one region. Oil markets are global by design. A shift in one node transmits through futures markets, shipping routes, currencies, and balance sheets worldwide. This is why oil shocks are described as global events, even when they originate from a single geography. The system is interconnected by necessity. There is no buffer large enough to isolate meaningful supply changes. When oil moves, the system moves with it. That is the starting point for understanding everything that follows. Venezuela is the largest broken asset on Earth. Venezuela occupies a position in the global energy system that is unmatched in scale and contradiction. It sits on the largest proven oil reserves on the planet, yet it operates as a marginal producer. This is not a natural outcome. It is the result of structural failure layered over extraordinary resource abundance. In functioning energy states, reserves translate into leverage. In Venezuela, reserves have remained dormant. The oil exists, but the systems required to extract, refine, and move it at scale collapsed long ago. Power in energy markets does not come from what lies underground. It comes from what can be delivered reliably to market. This distinction matters because markets do not price reserves. They price flow. Venezuela's flow deteriorated steadily while its reserve count remained intact. Over time, this created a distorted asset, immense in potential value but constrained by operational breakdown. The result is a resource base that appears enormous but behaves as if it were inaccessible. Broken assets of this magnitude are rare. Most countries either lack resources or lack scale. Venezuela has scale without function. Infrastructure decay, workforce erosion, and capital flight transformed what should have been a cornerstone producer into a systemic outlier. Output fell not because geology failed, but because the machinery of production did. For years, global markets treated Venezuelan supply as permanently impaired. Forecasts adjusted downward. Pricing models assumed absence. Other producers benefited from this exclusion. Gaining pricing power as a massive reserve base sat idle. The system adapted around Venezuela's dysfunction. This is why Venezuela matters far beyond its borders. It represents supply that was removed from the global equation without being exhausted. That removal was artificial. It was created by policy decisions, mismanagement, and isolation, not by depletion. As a result, the oil market developed under the assumption that this supply would not return. Broken assets attract attention because they imply asymmetry. The cost to restore functionality is often far lower than the value unlocked. In Venezuela's case, even partial rehabilitation would release volumes large enough to alter global balances. That gap between cost and impact is what makes the asset dangerous. Venezuela is not weak because it lacks oil. It is weak because it lacks operational control. When control shifts toward actors capable of restoring flow, the asset stops being broken. At that moment, the global system is forced to reprice assumptions it had come to rely on. How Venezuela was structurally dismantled. Venezuela's collapse as an energy producer did not happen suddenly. It unfolded through a series of structural decisions that steadily removed the foundations of a functioning oil system. The decline was mechanical, cumulative, and predictable. The turning point came with the nationalization of the oil industry in the late 2000s. Foreign operators were forced out, contracts were rewritten, and control was consolidated under the state. This was framed domestically as sovereignty, but structurally it functioned as an extraction of capital, expertise, and discipline from the system. Energy production at scale requires continuous reinvestment. Wells decline. Pipelines corrode. Refineries require constant maintenance. Once foreign capital and technical partners exited, reinvestment collapsed. What remained was an industry expected to operate indefinitely on aging infrastructure and shrinking technical capacity. For a short period, high global oil prices concealed the damage. Revenue continued to flow despite inefficiency. This masked operational decay and delayed market consequences. Output numbers weakened gradually, not abruptly, allowing dysfunction to embed itself before it became visible. As years passed, the absence of reinvestment became impossible to hide. Pipelines failed, refineries malfunctioned, equipment imports slowed, skilled engineers left the country. Each loss compounded the next. Production did not fall because reserves declined. It fell because systems failed faster than they could be repaired. This erosion created a feedback loop. Lower output reduced revenue. Reduced revenue further constrained maintenance and upgrades. Infrastructure failures became more frequent. Reliability disappeared. Buyers discounted Venezuelan oil, not for quality alone, but for delivery risk. Sanctions later intensified the decline, but they did not initiate it. By the time restrictions tightened, the industry was already structurally compromised. Sanctions froze decay in place. They prevented recovery, but the dismantling had already occurred. The result was an oil system that technically existed but could not function at scale. Venezuela retained ownership of reserves but lost operational command. In energy markets, ownership without execution has little meaning. Flow determines power, not entitlement. This distinction explains why Venezuela's collapse did not immediately trigger global shortages. The market adjusted gradually as output slipped. Other producers absorbed the slack. Over time, Venezuela's absence became normalized. Its supply was written out of forecasts, but normalization does not equal erasure. The reserves remained. The potential remained. What changed was the perception of permanence. Markets came to believe that Venezuela's dysfunction was irreversible. That belief anchored pricing assumptions for years. Structural dismantling creates fragility disguised as stability. Once capacity is written off, its reactivation becomes disruptive rather than incremental. Venezuela's oil sector was not destroyed, it was hollowed out. That difference matters because hollow systems can be rebuilt. And when they are, the impact is not marginal. Sanctions didn't create the collapse, they froze it. Sanctions are often described as the cause of Venezuela's oil collapse. That framing is inaccurate. The collapse was already underway. Sanctions did not dismantle the system. They locked it in its damaged state. By the time international restrictions intensified, Venezuela's oil sector had lost most of its functional capacity. Infrastructure was degraded. Production was unreliable. Capital had already exited. Sanctions entered a system that was structurally weakened, not one operating at full strength. What sanctions did was remove optionality. They cut off access to financing, equipment, spare parts, and insurance. They restricted who could legally buy, transport, and refine Venezuelan crude. This did not initiate decline. It prevented recovery. In energy markets, recovery requires connectivity. Equipment must move. Expertise must circulate. Capital must flow. Sanctions severed those channels. They froze Venezuela's oil system in a state of dysfunction, ensuring that decay could not be reversed even if internal policy shifted. This freeze forced Venezuela into dependence. With traditional buyers and partners excluded, the country relied on a narrow set of external actors willing to operate under risk. These relationships were not designed to rebuild capacity. They were designed to extract value from what little flow remained. China became the primary beneficiary of this arrangement. It absorbed discounted Venezuelan oil, often under opaque terms. These flows sustained minimal output, but did nothing to restore infrastructure or efficiency. The objective was supply access, not system repair. As a result, Venezuela's oil sector entered a holding pattern. Production stabilized at low levels. Decline slowed, but recovery never began. The system remained intact enough to exist, but not functional enough to grow. This is the hallmark of a frozen asset. Markets adjusted accordingly. Venezuelan supply was treated as structurally sidelined. Forecasts excluded meaningful recovery. Pricing models assumed permanence. Over time, sanctions transformed temporary dysfunction into assumed absence. This distinction is critical. A destroyed system must be rebuilt from scratch. A frozen system can be reactivated once constraints are removed. Venezuela's oil industry falls into the second category. The core asset remains. The blockage sits around it. Sanctions also reshaped incentives. With recovery blocked, internal reform lost urgency. External partners had no reason to invest in long-term capacity. Short-term extraction replaced structural rebuilding. The system survived, but it did not heal. This is why sanctions matter in the current reset. When restrictions loosen or are bypassed by operational control, the freeze begins to thaw. Capacity does not return instantly, but expectations change immediately. Sanctions delayed Venezuela's return to the market. They did not erase it. By freezing collapse instead of completing it, they preserved the potential for a disruptive re-entry. That potential is now being reassessed, and the market is responding to the possibility rather than the past. The U.S. objective is marginal supply control. The United States' approach to Venezuela is best understood through the logic of supply mechanics, not diplomacy. The objective is not symbolism or regime alignment. It is control over marginal supply in a market where marginal barrels determine price direction. Oil markets do not move based on total reserves. They move based on incremental changes in available supply. The producer that can add or remove barrels at the margin holds disproportionate influence over pricing expectations. Venezuela's sidelined output represents one of the largest pools of marginal supply in the world. For years, this supply was effectively frozen. That freeze supported higher prices and reinforced the leverage of other producers. Once the possibility of reactivation enters the equation, that balance begins to shift. Control over Venezuela's production potential becomes a strategic asset not because of current output, but because of what could be brought online. American oil companies operate with scale, capital access, and technical depth. They specialize in rehabilitating complex, degraded systems. From a market perspective, Venezuela is not a political problem. It is an engineering and logistics problem. Those problems are solvable with capital and operational discipline. This is why infrastructure sits at the center of the strategy. Pipelines, refineries, ports, and transport networks determine whether oil is power or dormant wealth. Whoever controls these systems controls flow. Flow determines relevance. Even modest increases in Venezuelan output would have outsized effects. A few 100,000 additional barrels per day entering global circulation would alter supply forecasts, weaken coordinated production restraint, and apply downward pressure on prices. The market does not require full restoration to react, it reacts to direction. This strategy aligns with broader macroeconomic incentives. Energy costs feed directly into inflation. Lower or more stable oil prices ease pressure across transportation, manufacturing, and consumer goods. In an environment where monetary policy is constrained, supply-side energy relief functions as an indirect stabilizer. The language of reimbursement and compensation reinforces this logic. Increased production is framed not as generosity but as recovery of value. This framing legitimizes aggressive output strategies while maintaining domestic political support. It positions oil flow as corrective rather than exploitative. Volatility is not an obstacle to this approach. It is part of the mechanism. Short-term uncertainty destabilizes existing pricing structures and forces repositioning. As volatility rises, weaker hands exit. Stronger operators gain influence. From a strategic standpoint, Venezuela also functions as a deterrent. Its latent capacity disciplines the market by existing as a credible threat to pricing power. Even if production ramps slowly, the knowledge that it can ramp changes behavior elsewhere. This is not a short-term play, it is a structural repositioning. Control over Venezuela's marginal supply reshapes the global oil curve and reasserts influence over a commodity that still anchors the world economy. Once marginal control shifts, the market adjusts around it. Markets reset on expectations, not output. Oil markets do not wait for physical change to occur. They move when expectations change. This is a defining feature of energy pricing and a critical mechanism in every structural reset. The market responds first to probability, not confirmation. Futures markets exist to price what is likely, not what is visible. When credible actors position themselves to restore supply, the effect is immediate. Traders, institutions, and producers adjust forecasts before a single additional barrel reaches the system. Direction matters more than completion. This is why Venezuela's relevance returns the moment reactivation becomes plausible. Output does not need to recover to historical highs to matter. The belief that sideline supply is no longer permanently stranded is enough to alter assumptions across the curve. Once expectations shift, pricing power weakens elsewhere. Producers that benefited from scarcity narratives face erosion of leverage. Coordinated restraint becomes harder to enforce. The threat of new supply disciplines behavior even if production ramps slowly. Volatility emerges at this stage because uncertainty dominates. Markets struggle to quantify timing, scale, and durability. That uncertainty expresses itself through sharp moves, reversals, and exaggerated reactions. This is not irrational behavior. It is the system repricing risk in real time. Oil markets are heavily leveraged, and leverage amplifies expectation-driven moves. Positions built on assumptions of tight supply unwind rapidly when those assumptions are challenged. Price action overshoots before stabilizing, reflecting repositioning rather than fundamentals alone. This expectation-driven phase always precedes structural change. It flushes out weak conviction and reallocates capital toward those aligned with the emerging trajectory. China is the strategic casualty. China's position in Venezuela was built on absence. When Western capital withdrew and sanctions tightened, China stepped into the vacuum. This was not a reconstruction effort. It was an extraction strategy designed to benefit from isolation rather than resolve it. For years, China absorbed the majority of Venezuela's oil exports. These flows were often discounted, irregular, and operationally inefficient, but they served a strategic purpose. They reduced China's reliance on other suppliers and expanded its optionality within the global energy system. This arrangement worked only because Venezuela remained structurally broken. China's leverage depended on exclusion. As long as Western operators were absent and infrastructure remained degraded, China retained preferential access. The moment that condition changes, the advantage erodes. China never rebuilt Venezuela's oil system at scale. It did not modernize refineries or restore production capacity. Its interest was security of supply under favorable terms, not the restoration of Venezuela as a competitive producer. Dependency, not efficiency, was the foundation of the relationship. The re-entry of U.S. operational influence disrupts this equilibrium. Control over infrastructure and production determines who gets priority access and who sets terms. If American companies regain command of flow, China shifts from preferred buyer to competing customer. This shift does not trigger an immediate energy crisis for China. The country has diversified suppliers, but it does tighten margins. Discounted Venezuelan oil provided flexibility. Losing it forces substitution under less favorable conditions. In a system already managing slower growth and internal imbalances, reduced flexibility matters. The impact is cumulative rather than dramatic. Energy costs feed into manufacturing margins, export competitiveness, and inflation dynamics. Even small increases compound over time. China's growth model is sensitive to input stability. Disruptions at the margin compress strategic space. There is also symbolic weight. Venezuela was a clear example of China's ability to convert Western withdrawal into influence. It demonstrated that isolation created opportunity. Reversing that outcome sends a broader signal. Access secured through fragility can be revoked through re-engagement. This precedent extends beyond Venezuela. China has pursued similar strategies in other resource-rich but operationally weak states. The Venezuelan reset forces a reassessment of risk across those positions. Dependency-based influence is inherently unstable once structural weaknesses are addressed. From the U.S. perspective, this outcome is efficient. It weakens a strategic rival without direct confrontation. Energy flows perform the work quietly. There is no need for escalation. Control over infrastructure and supply reshapes the balance indirectly. China's displacement illustrates a core principle of modern geopolitics. Influence built on broken systems is temporary. Once those systems are repaired under competing control, leverage dissolves. Venezuela's reactivation closes a window that China relied on. This does not end competition. It narrows options. In a world defined by marginal advantages, narrowing options shifts momentum. The oil reset therefore functions as a power reset. It constrains China's room to maneuver by altering the structure of energy access. China remains a major global actor. But in Venezuela, it moves from beneficiary to bystander. That transition reflects a broader pattern. As stranded assets are reactivated, those who benefited from dysfunction lose ground. The system adjusts accordingly. Volatility is the weapon, not the side effect. Volatility is not an accident of the oil reset. It is the mechanism through which the reset operates. When structural control over energy shifts, markets do not reprice smoothly. They destabilize first. That instability is functional. Oil markets are forward-looking and heavily leveraged. When expectations fracture, positions unwind rapidly. This produces sharp price movements that appear disconnected from fundamentals, but are anchored in uncertainty about future supply, control, and access. In the early phase of an energy realignment, fear moves faster than arithmetic. Traders react to what could happen before they can measure what will happen. This creates spikes, reversals, and gaps that punish static positioning. Volatility forces adaptation. This turbulence serves a purpose. It flushes out participants anchored to outdated assumptions. Scarcity-based pricing models weaken. Confidence in coordinated restraint erodes. The market begins to operate under a new set of probabilities rather than old certainties. Leverage amplifies this process. Energy markets carry significant speculative exposure. When narratives shift, leveraged positions become unstable. Liquidations accelerate price movement. Volatility feeds on itself, not because the system is broken, but because it is adjusting. This adjustment does not stay contained within oil. Energy volatility transmits into equities, currencies, and credit. Inflation expectations react first, then policy expectations. Central banks are forced to interpret whether price moves reflect temporary shocks or lasting structural change. That ambiguity slows response. Markets move faster than institutions. In that gap, repricing intensifies. The oil reset exploits this delay. Uncertainty stretches decision timelines while capital reallocates aggressively. Short-term price spikes driven by fear can coexist with long-term downward pressure driven by supply logic. This creates a whipsaw environment where conviction is costly and flexibility is rewarded. The reset is not linear. It advances through dislocation. Over time, structure reasserts itself. Supply expectations stabilize. Prices find a new range. But the path there extracts a toll. Participants who fail to recognize volatility as a feature rather than a flaw are repeatedly wrong-footed. Volatility also carries a signaling function. It communicates that prior equilibria no longer hold. It conditions the market to expect instability during transition. This changes behavior even after prices settle. Risk premiums embed themselves into planning and investment. In this sense, volatility reshapes psychology as much as valuation. It reminds the system that energy control is contested and conditional. That reminder lingers long after headlines fade. The oil reset is not defined by calm resolution. It is defined by sustained adjustment. Volatility is how the system processes that adjustment. It is not noise around the reset. It is the reset expressing itself in real time. Reset ends with redistribution, not resolution. The oil reset does not conclude with stability. It concludes with redistribution. Control shifts, pricing power relocates, and the structure of the market settles into a new hierarchy. Resolution is not the objective. Reordering is. As Venezuelan supply re-enters the global equation under new operational control, the balance between producers and consumers changes. Traditional exporters that relied on scarcity narratives face sustained pressure. Their leverage weakens as latent capacity becomes credible again. This redistribution favors operators over owners. Energy sovereignty, in practical terms, migrates toward those who can extract, process, and distribute reliably at scale. Ownership without operational capability loses relevance. Control follows execution. Consumers benefit from this shift. Lower or more predictable energy costs ease inflationary pressure across supply chains. Transportation, manufacturing, and logistics recalibrate. Margins expand where energy intensity was previously a constraint. These gains are uneven, but they are structural. Producers dependent on higher prices absorb the opposite effect. Fiscal balances tighten. Policy options narrow. Some adapt by diversifying. Others resist by attempting renewed coordination. But coordination is harder to sustain when credible supply threats exist. This rebalancing extends beyond oil. Currencies of energy exporters reprice. Capital flows adjust. Investment patterns change as assumptions about long-term scarcity weaken. Energy-intensive economies gain relative competitiveness. Resource-dependent systems face pressure to restructure. The reset also reshapes expectations. Markets internalize the lesson that supply constraints can be political and technical rather than geological. This reframes long-term pricing models. Risk premiums adjust accordingly. Stability becomes conditional rather than assumed. Over time, a new equilibrium forms. Prices settle within ranges that reflect expanded contestability and altered control. Volatility diminishes, but it does not disappear. The memory of disruption lingers, influencing behavior and decision-making long after the transition phase ends. This is how energy wars resolve in the modern era. Not through decisive victories, but through durable shifts in structure. Power redistributes quietly. Systems adapt. The outcome becomes normalized. Venezuela's role in this process is illustrative rather than unique. It demonstrates how stranded capacity can reshape global dynamics once constraints are lifted. The lesson extends to other resource hubs where operational weakness masks latent supply. The oil reset underway confirms a broader truth. Economic power follows control over foundational inputs. When that control moves, downstream effects propagate through money, trade, and influence. This reset is already embedded in market behavior. It is reflected in expectations, volatility, and strategic positioning. The system has begun adjusting. The direction is set, even if the path remains uneven. Thank you for listening. Based on everything you heard, which side do you think is gaining more ground right now? Share your view in the comments and explain why.